Listen up. I'm going to save you from making the dumbest investment mistake of 2026, and I don't care if this makes you uncomfortable. You know what I care about? Your money not evaporating while you sleep. I'm Kevin O'Leary, Mr. Wonderful, and I've been in this game for 40 years building billion-dollar portfolios while watching amateur investors flush their retirement down the toilet. Cold, hard data doesn't lie. And right now, the data is screaming at you to stay away from two specific ETFs that Wall Street marketing machines are shoving down your throat. But before I tell you which funds are going to destroy your wealth, you need to understand why 90% of investors are walking straight into a financial bloodbath. Here's what nobody's telling you. The ETF industry has become a bloated monster, pumping out funds faster than you can say expense ratio. There are now over 3,000 ETFs in the United States alone. 3,000. And you know what that means? It means most of them are garbage, pure, unadulterated garbage designed to separate you from your hard-earned cash. Let me break down the cold, hard truth. When you buy an ETF, you're not just buying the underlying assets. You're paying fees. You're taking on structural risk. You're betting that the fund manager or the index methodology actually knows what they're doing. And here's the kicker. Most of them don't. I've seen it happen over and over again. Investors get seduced by flashy marketing, past performance that means absolutely nothing, and promises of revolutionary strategies that will make them rich. Then what happens? They watch their portfolios bleed out while the fund companies rake in management fees regardless of whether you make money or lose your shirt. The biggest lie in investing is that all ETFs are created equal. They're not. Some ETFs are weapons of mass financial destruction, and in 2026, two funds stand out as particularly dangerous. I'm talking about funds that combine the worst possible characteristics: high expense ratios that eat your returns like termites, concentrated positions that amplify risk instead of diversifying it, structural problems that guarantee underperformance, and worst of all, marketing hype that convinces unsuspecting investors to pour money into them. You want to know what really gets me fired up? It's watching people work their entire lives, save diligently, and then throw it all away on investment products that were designed to fail from day one. I've built multiple companies, I've made fortunes and lost fortunes, and I can tell you with absolute certainty that the number one rule of investing is simple. Don't lose money. Warren Buffett said it. I live it. And these two ETFs violate that rule every single day. The first warning sign you need to understand is leverage. The second is active management without the track record to justify it. The third is expense ratios above 75 basis points for passive strategies. And the fourth is concentration risk that puts all your eggs in baskets that are already cracked. Right now, as we head into 2026, the market is at a critical inflection point. Interest rates are still elevated. Inflation hasn't been completely tamed. Geopolitical tensions are running hot, and technology valuations are stretched thinner than a piece of cellophane. This is not the time to be taking unnecessary risks with leverage products or betting on star managers who've already proven they can't deliver. So what are these two ETFs I'm warning you about? Stick with me because I'm about to name names, show you the data, and explain exactly why owning these funds in 2026 is financial suicide. Let's start with the first category of death traps: leveraged ETFs. And I'm going to use a specific example that perfectly illustrates why these products are poison for 99% of investors. I'm talking about funds like the Direction Daily Semiconductor Bull 3X shares, ticker SOXL, or the ProShares Ultra Pro QQQ, ticker TQQQ. Now, before you start screaming at me that these funds have made people rich, let me stop you right there. Yes, in a raging bull market, leveraged ETFs can produce spectacular short-term gains. But here's what the fine print doesn't tell you. These funds are designed for day traders, not investors. They reset daily. Daily. Do you understand what that means? It means that if you hold a 3x leveraged ETF for more than one trading session, you're exposed to something called volatility decay. This is a mathematical certainty that will destroy your returns over time, even if the underlying index goes up. Let me give you a concrete example. Say the NASDAQ goes up 10% one day and down 9% the next day. You'd think you're basically even, right? Wrong. With a 3x leveraged ETF, you'd actually be down significantly due to the compounding effect of daily resets. The expense ratios on these leverage monsters are insane. We're talking 95 basis points, sometimes over 1%. That's 12 times higher than a simple S&P 500 index fund that charges 8 basis points. You're paying 1,200% more in fees for a product that's mathematically designed to underperform over any meaningful time horizon. But wait, it gets worse. The Securities and Exchange Commission recently halted applications for 3x and 5x leveraged ETFs because even the regulators understand these products are too dangerous. When the SEC, an organization that usually moves slower than molasses, steps in to protect investors, you know something's seriously wrong. Let me hit you with some data. According to Morningstar's analysis from December 2025, leveraged ETFs that short winning sectors have lost more than 80% of their value year to date. 80%? That's not an investment. That's a casino on steroids where the house always wins and you always lose. Here's the psychology trap that gets investors killed. You see a tech sector going up and you think, if I can get 3 times the return, I'll get rich faster. It sounds logical until you understand the math. Over 5 years, a 3x leverage technology ETF that should theoretically give you 3 times the return of the underlying index will actually underperform dramatically due to volatility, decay, rebalancing costs, and those sky-high expense ratios compounding against you every single day. I want to make this crystal clear. If you're holding a leveraged ETF for more than 24 hours, you're not investing, you're gambling. And the odds are stacked against you worse than any slot machine in Las Vegas. At least in Vegas, you know you're gambling. With leveraged ETFs, Wall Street dresses it up in fancy financial engineering and convinces you it's a sophisticated investment strategy. The target audience for these products should be professional traders with sophisticated risk management systems, split-second execution capabilities, and the ability to monitor positions constantly. That's not you. That's not me. That's not 99.9% of the investing public. Now here's where it gets personal. I've seen retirement accounts destroyed by leveraged ETFs. I've watched investors who were on track for a comfortable retirement lose 30, 40, 50% of their nest egg in a matter of months because they didn't understand what they were buying. They saw the ticker, they saw the 3x multiplier, and they thought they found the secret to getting rich quick. Let me tell you the secret to getting rich. It's boring. It's disciplined. It's low-cost index funds held for decades with regular contributions regardless of market conditions. That's it. That's the whole secret. But nobody wants to hear that because it doesn't promise overnight riches. The worst part about leveraged ETFs isn't just the terrible performance, it's that they create a false sense of sophistication. People buy them thinking they're being smart, strategic, aggressive investors. In reality, they're victims of financial products designed to generate massive fee income for the issuers while transferring wealth from naive investors to Wall Street banks. In 2026, with market volatility likely to remain elevated, with the Federal Reserve still navigating monetary policy, with geopolitical risks from China to the Middle East, the last thing you need is a leveraged ETF amplifying every market swing by 3 times. One bad week in the market becomes a catastrophic loss in your portfolio. So here's my warning. If you own any leveraged ETF right now, any 3x fund, any 2x fund, sell it tomorrow morning. Take your losses if you have to. Get out. Move that money into a broad-based, low-cost index fund and never look back. And if you don't own leveraged ETFs, but you're thinking about buying them because some YouTube guru told you it's the fast track to wealth, save yourself the tuition payment to the School of Hard Knocks. These products will chew you up and spit you out. Leveraged ETFs are not investments. They're trading instruments for professionals. And even professionals lose money on them more often than not. Do not buy them in 2026. Do not hold them in 2026. Stay away. Now let's talk about the second ETF you need to avoid in 2026. And this one's going to be controversial because it has a cult following. I'm talking about the ARK Innovation ETF, ticker RKK, managed by Cathie Wood. Before the hate mail starts pouring in, let me be clear. I'm not attacking Cathie Wood personally. I'm attacking the fund structure, the performance, the fees, and the risk profile. And the data backs me up completely. Let's start with the most important metric, performance. From its peak in February 2021 to today, RKK has lost more than 70% of its value. 70%. Meanwhile, the S&P 500 has been making new all-time highs. If you invested $10,000 in IRKK at the peak, you'd have $3,000 left. If you invested that same $10,000 in a boring S&P 500 index fund, you'd have over $14,000 today. But here's what really makes my blood boil. Despite this catastrophic underperformance, ARK Invest has collected over $300 million in management fees. $300 million. The fund charges 75 basis points annually. That means even as investors were losing their shirts, Cathie Wood was collecting millions in fees. That's the dirty secret of the asset management industry. The managers get paid regardless of whether you make money or lose money. Now let's talk about the strategy. ARKK invests in what they call disruptive innovation. Sounds exciting, right? Revolutionary companies that are going to change the world. The problem is, most of these companies are unprofitable. Cash-burning machines trading at absurd valuations based on hopes and dreams rather than actual earnings. The fund's top holdings read like a who's who of speculative technology stocks, companies with no earnings, no clear path to profitability, and business models that depend on perfect execution in highly competitive markets. When interest rates were zero and money was free, these stocks went to the moon. But now, in a higher rate environment where investors actually care about cash flow and profitability, these stocks have crashed back to earth. Here's the fundamental problem with RKK's strategy. It's concentrated. The fund holds only about 40 stocks. That's not diversification, that's concentrated risk. When you buy ARKK, you're essentially betting that Cathie Wood can consistently pick the winning disruptive companies while avoiding the losers, and the track record shows she can't. The portfolio turnover is astronomical. ARKK trades its holdings constantly, racking up transaction costs and generating taxable events for investors. High turnover is a double whammy. You pay more in costs and you destroy tax efficiency. It's the exact opposite of what smart long-term investors should do. Let me address the bull case for RKK because I know people are going to say, but Mr. Wonderful, what about the long-term vision? What about innovation? What about being early to transformative technologies? Here's my answer. Being early is indistinguishable from being wrong if you lose all your money before the thesis plays out. Yes, some of the companies in RKK might eventually become massive success stories. But as an investor, you can't afford to wait 10 or 15 years while your capital is tied up in underperforming stocks. Time is money. Opportunity cost is real. Every dollar you have locked up in ARKK generating negative returns is a dollar that could be growing in a profitable investment. The other problem with thematic investing in general, and ARKK specifically, is that by the time a theme becomes obvious enough to build an ETF around it, it's usually too late. The easy money has already been made, the valuations have already expanded, and you're buying at the top of the hype cycle. Look at what happened with genomics, one of RKK's big themes. Great story. The future of medicine, personalized healthcare, revolutionary potential. But the stocks in that sector have been demolished because the timeline to profitability is measured in decades, not years, and investors have lost patience. Here's what really bothers me about RKK. It attracts the exact wrong type of investor. Young people, inexperienced investors, people who can least afford to lose money, get seduced by the narrative of innovation and disruption. They pour their savings into the fund thinking they're investing in the future. Instead, they're funding an expensive, underperforming, tax-inefficient vehicle that destroys wealth. The expense ratio of 75 basis points might not sound like much, but let me put it in perspective. You can buy the Vanguard Total Stock Market ETF for 3 basis points. 3. That's 25 times cheaper than ARKK. Over 30 years, that difference in fees alone will cost you hundreds of thousands of dollars due to compounding. Now I know the counter-argument. Active management is supposed to justify higher fees through superior returns. But ARKK hasn't delivered superior returns. It's delivered catastrophic underperformance. When an active manager underperforms their benchmark by 50, 60, 70% and still charges premium fees, that's not active management, that's wealth destruction. In 2026, I see no reason why RKK's fortunes will reverse. Interest rates are likely to stay higher for longer. Profitability matters again. Speculative growth stocks without earnings are out of favor. The macroeconomic environment is hostile to the exact types of companies RKK invests in. My advice is simple. If you own ARKK, sell it. Take your tax loss if you need to. Move that money into a diversified, low-cost index fund. And if you're thinking about buying ARKK because you believe in innovation, save yourself the pain. You can believe in innovation without investing in an expensive, poorly performing ETF. Buy individual stocks if you want to bet on specific companies, or better yet, own the whole market through an index fund and capture all the innovation without the concentrated risk. RKK is not the future. It's a cautionary tale. Avoid it in 2026. So what should you do instead? It's not complicated, it's not sexy, but it works. Number 1, own broad-based, low-cost index funds, the Vanguard S&P 500 ETF, the iShares Core S&P Total U.S. Stock Market ETF. These funds charge single-digit basis points in fees. They give you instant diversification across hundreds or thousands of companies, and they've consistently beaten the vast majority of active managers over time. Number 2, ignore the hype. Every year, Wall Street launches new ETFs with exciting themes and promising narratives. Artificial intelligence ETFs, clean energy ETFs, metaverse ETFs, 99% of them will underperform the market. Don't be the sucker funding the marketing budgets of ETF issuers. Number 3, understand what you own. If you can't explain your investment thesis in 3 sentences, you don't understand it well enough to own it. Complexity is not your friend in investing. The simplest strategies usually win. Number 4, focus on what you can control. You can't control market returns. You can't control which stocks or sectors will outperform, but you can control your fees, you can control your asset allocation, you can control your behavior, keep fees low, maintain appropriate diversification, and don't panic during market downturns. Number 5, think in decades, not days. The worst thing you can do is chase short-term performance. The best performing ETF of last year is often the worst performer of next year. Mean reversion is a powerful force. Build a portfolio designed to compound wealth over 20, 30, 40 years. Number 6, avoid leverage, avoid concentration, avoid high fees. These are the 3 killers of long-term wealth creation. If an ETF exhibits any of these characteristics, run the other way. Here's the reality. You don't need complicated strategies to build wealth. You need discipline. You need patience. You need to avoid the massive mistakes that wipe out decades of gains. And in 2026, those mistakes have names. They're called leveraged ETFs and actively managed, high-fee, concentrated funds that promise the moon but deliver losses. Let me be blunt. If you ignore this warning and buy these ETFs anyway, you're going to lose money. It's not a prediction. It's a mathematical certainty based on fee structures, volatility decay, and demonstrated underperformance. I didn't build a $400 million net worth by gambling on leveraged products or chasing hot fund managers. I did it by being disciplined, avoiding stupid mistakes, and letting compound interest work in my favor over decades. Your financial future depends on the decisions you make today. Every dollar you invest in a bad ETF is a dollar you're not investing in something that could actually grow your wealth. The opportunity cost is staggering. So here's what I want you to do right now. Go check your portfolio. If you own leveraged ETFs, schedule a sell order for tomorrow morning. If you own ARKK or similar high-fee, underperforming active ETFs, do the same thing. Then take that money and put it in a low-cost index fund where it belongs. This isn't about being conservative or aggressive. It's about being smart. It's about understanding math, understanding incentives, and understanding that Wall Street makes money when you trade, not when you succeed. Don't be the sucker in 2026. Avoid these ETFs, protect your wealth. And remember, the goal isn't to beat the market by huge margins. The goal is to participate in the market's growth while avoiding catastrophic mistakes. Do that and you'll be wealthier than 90% of investors out there.